Hey there, investors! Let's talk options. Specifically, we're diving into two strategies that make you money when a stock goes wild. Long straddles and long strangles. Sound complicated? Don't worry, I'm here to break it down. Both strategies are all about volatility. You're betting that a stock will move a lot in either direction. You don't even care which way it goes, just as long as it makes a big move. Why use these strategies? Think earnings announcements, major news events, or anything that could send a stock soaring or plummeting. In the next few sections, we'll unpack each strategy, look at examples, and figure out when to use them. Buckle up! First up, the long straddle. This strategy is like saying, I think this stock is going to explode, but I don't know which way. Here's how it works. You buy a call option and a put option on the same stock with the same strike price and expiration date. Remember, a call option gives you the right to buy the stock at a certain price, while a put option gives you the right to sell it at a certain price. By buying both, you're covered whether the stock goes up or down. The bigger the move, the more money you make. Of course, if the stock barely budges, you lose. More on that later. Let's look at an example to make it crystal clear. Imagine you're eyeing Apple, AAPL, before their big product launch. You're expecting fireworks, but you're not sure if the new iThing will be a hit or a flop. AAPL is trading at $150. You decide to buy a call option and a put option, both with a strike price of $150 and an expiration date a month out. Let's say each option costs $5, or 5 times 100, since each option's contract represents 100 shares of the underlying. Your total cost? $10 per share. That's $5 for the call and $5 for the put. AGN times 100, so $1,000. Now let's look at different scenarios. Scenario 1. AAPL skyrockets to $170. Your call option is now worth at least $20, the difference between the stock price and the strike price. Even if your put option expires worthless, you've made a tidy profit. Scenario 2. AAPL crashes to $130. Your put option is now worth at least $20, more than making up for the worthless call option. Victory. Scenario 3. AAPL stays flat at $150. Both your options expire worthless and you lose your initial $10 investment. Ouch! As you can see, the long straddle is all about volatility. The bigger the move, the better. Now let's talk about the long strangle. It's similar to the long straddle, but with one key difference. You buy out-of-the-money options. Remember, an out-of-the-money OTM option has a strike price that's different from the current stock price. For a call option, the strike price is higher. For a put option, it's lower. By buying OTM options, you're paying less upfront. However, the stock needs to move even more for you to make a profit. Let's see how this plays out in the real world. Section 5. Setting up a long strangle. Another example. Let's revisit our Apple example. Instead of buying options at the $150 strike price, you decide to go for a long strangle. You buy a call option with a strike price of $160 and a put option with a strike price of $140, both with the same expiration date as before. Because these options are out of the money, they're cheaper, let's say $3 each. Your total cost for the strangle? $6 per share, that's $3 for the call and $3 for the put. Here's how the scenarios change. Scenario 1, Apple soars to $170. Your call option is now worth at least $10, and you've still got a chance with the put option. You're in the money. Scenario 2. Apple plunges to $130. Your put option is now worth at least $10, and your call option still has a chance. Winning! Scenario 3. Apple hovers around $150. Both your options expire worthless, and you lose your initial $6 investment. Not as bad as the straddle loss. The long strangle is cheaper than the straddle, but it requires a larger price swing to be profitable. Section 6. Key differences, straddles versus strangles. So what's the main difference between these two strategies? It all comes down to cost and break-even points. Cost long strangles are cheaper to set up because you're buying out of the money options. Break even. Long straddles have a lower break-even point because the options are at the money. This means the stock doesn't need to move as much for you to start making money. Remember, cheaper doesn't always mean better. It all depends on your outlook for the stock's volatility. Section 7. Risk and reward, what you need to know. Both long straddles and strangles involve significant risk. Here's the deal: limited profit potential. Your profit is limited to how much the stock moves beyond your break-even points. Unlimited risk. If the stock moves against you, your losses can be substantial, especially with a straddle. Time decay. Options lose value over time. If the stock doesn't move enough before your options expire, you could lose your entire investment. It's crucial to understand these risks before diving in. Section 8. When to use each strategy. Finding the right fit. So, when should you use each strategy? Long straddle. Use this when you expect a large price move but are unsure of the direction. Earnings announcements are a classic example. Long strangle. Use this when you expect a significant price move but are willing to accept a lower probability of profit for a lower cost. Remember, these strategies are best suited for experienced traders who understand the risks involved. Section 9. Advice for beginners. Tread carefully in the options market. Options trading can be exciting, but it's not for the faint of heart. If you're new to the game, here's my advice. Start small. Don't bet the farm on your first trade. Begin with small positions and gradually increase your exposure as you gain experience. Do your homework. Thoroughly research the underlying asset and understand the factors that could influence its price. Manage your risk. Use stop-loss orders to limit potential losses, and always have an exit strategy in mind. Options trading can be a powerful tool for sophisticated investors, but it's crucial to approach it with caution and a healthy dose of respect. And remember, there's no shame in seeking guidance from a financial advisor. Happy trading. Hey, if you found value in this explanation video, please like, subscribe, and comment to help this new channel gain traction by joining the Cash Money team.